Good afternoon. My name is Dimitri Iliopoulos, and I'm the Chief Executive Officer at Curi RMB Capital. And on behalf of our entire organization, I wanted to welcome everybody today to a timely session on our perspective on the market and the economy. Joining me today is our Co-Chief Investment Officer, Chris Graff. He's going to walk you through the majority of the material. One of the things I wanted to share from a housekeeping perspective as we get started here is if a question comes up during Chris's presentation, feel free to enter that question in the chat. And when he completes his slides, we will review those questions and work to answer them for you. Here's the agenda for today that Chris will share. I will kick things off by providing everybody with a brief overview of our organization. As many of you know, we completed a merger of Curi and RMB Capital on January the 1st, and I wanted to share a brief update of how all that is going. Then I'm going to turn things over to Chris, and given where we are post the recent elections here in the United States, we have some perspective on some key aspects of the economy and the market that he would like to share with you. And then we'll open it up to Q&A. So on January 1st of this year, we made the announcement that Curi Capital and RMB Capital were merging and joining forces, bringing our two organizations together. And I'm excited to share with all of you today that 11 and a half months into our merger and our integration, that things are going really, really well. Our teams have been spending time getting to know one another across the country. There's been very proactive collaboration taking place. And as you can imagine, when you're going through a merger and an integration like the one we are, there's a long list of projects and tasks that need to be completed. And many of those have been completed. Many are on schedule to be completed. And we feel really good about the integration really taking full form by the end of the first quarter next year. The other thing that's really important for those of you who are listening in that are clients of ours, we're taking the time to actually integrate and to merge. There is quite a bit of M&A in our space, and a lot of organizations do multiple deals throughout the year, if not months. We're taking the time to actually bring our people from our two organizations together into one so we can create a better team and better solutions for all of you going forward. So on the next slide, you'll see what our organization looks like as of last week. We're just short of $14 billion of assets under management. We're really excited and proud to serve nearly 3,100 families across the United States. You can see in the third column from the right, the blue column, where we have all of our office location, where our 180 team members live and work and reside. And one of the things that we really wanted to highlight is earlier this year, we were recognized in Barron's top 100 list of RIAs around the country. There are 15,000 RIAs in the United States of America. We know that as investors and consumers, you have a lot of options to choose from. To be recognized on this list in the top 100 and to be on this list for the ninth consecutive year is something that we're really excited about, not because we want to be on those lists, but this is one of those lists that is not pay to play and is truly being done subjectively by a well-recognized and highly reputable organization that's been around for over 100 years in Barron's. So that makes us feel good and continues to motivate us to invest in the company and to invest in the services and solutions that we offer you. So before I turn it over to Chris, and he shares his perspective on the economy and the market, we had our elections in this country not too long ago, and we do know that elections do matter. But when it comes to our investments and the asset allocation decisions that we make to build portfolios for you, there are a lot of other factors that matter just as much, if not more. Where we are in the business cycle matters. Where we are in the economic cycle matters as well. We have a significant deficit in this country that's likely going to grow. That impact will eventually present itself to investments in the capital markets. We know that there are tensions, geopolitical tensions around the world in Ukraine and in the Middle East. AI has been front and center for the last 12 to 18 months, and it's a super powerful innovation, but also very disruptive. And how companies adapt and adopt AI is going to play a big factor. There's a lot of talk about the current tax policy that we have in this country extending, or potentially the opportunity of tax cuts and less regulation and fewer guardrails, which could lead to more growth and more opportunity. But that situation also could lead to more risk. And it's something that we're watching and paying attention to very closely. But ultimately, what does matter are your goals and the asset allocation that you and your advisor team are working on to support those goals. And that's the type of objective view we're going to take on the markets and the economy as we look to navigate our go-forward path together. So that's the framework that I wanted to share with all of you. I'm going to turn things over to Chris Graff, and he'll zero in on a couple different factors in our economy and the market today. And once Chris is done, as I said before, we will review some of the questions that come in through the chat. Thank you. And Chris, I'll turn things over to you.
Thanks, Dimitri. And thanks again to everyone for joining us today for our market outlook discussion. As Dimitri mentioned, a very timely conversation given recent events, not only the election, but the first interest rate cut from the Fed back in September. So as always, we try and frame the conversation and the content for these discussions around key questions we're hearing from clients. As Dimitri mentioned, we'll try and cover a lot of your questions, but to the extent that we don't get to it, we'll wrap it up at the end with a more open Q&A discussion. So to get going, of course, the big topic on everyone's mind just in the past few weeks, and of course in the months leading up to the elections, has just been what kind of impact could we expect from the outcome of the election. So in an election year, we get a lot of questions about changes in the economy, changes in fiscal policy, how that can impact the stock and bond markets, and so on. And of course, one of the most common questions we get immediately after the event is what kind of impact, immediate impact, will the outcome of the election have on the stock and bond markets? So this chart looks at statistical analysis going back to the 1920s of election year impact around the event itself, right around the election. So the 12 months leading up to the election, as well as the 12 months after. And then it color codes sort of breaks down whether the incumbent party won in blue, whether the incumbent party lost in yellow, and then the averages during the same time period in green. So a couple of takeaways from this chart. I think what you can see is there's some variation across the different time periods based on different outcomes. What we would say is the further out from the event itself, the actual election, the more noise there is in terms of trying to interpret what's impacting stock market returns. A lot of different factors can contribute to that. So what we try to focus on is a little bit shorter term, particularly what's highlighted in that dotted box area in the middle of the chart. If we look at just the 1 month post the election, we can see that it tends to be the case for the stock market, the S&P 500, that when there's a change in leadership, the stock market tends to respond better. Now, that may not be the case in every scenario. Obviously, a lot of different considerations there, but on average, that's been the case historically. So let's think about that in the context of what we saw on Wednesday, November 6th, the day after the election. That day in the markets, we saw the broad S&P 500, the broad stock market, up about 2 or 3 percentage points. We saw smaller cap stocks up about 6 percentage points. We saw the financial sector up over 10%, which has been fairly out of favor and somewhat depressed over the past few years for a variety of different reasons. We saw the dollar strengthen. We saw gold kind of flattened down. We saw Bitcoin rally a lot. So a lot of different sort of immediate reactions as investors tried to price in some expectations going forward. So we'd emphasize 2 things as we think about trying to read the results of the election in the stock market. First and foremost, leading up to the event itself, it wasn't clear whether we would know the outcome the next day, how long it would take to count votes in swing states, if there would be some controversy or dispute around the election results, given previous experience. So the simple fact that we woke up on Wednesday the next morning with a pretty clear outcome, a pretty clear result, that was really positive for the stock market as it removed a fair amount of uncertainty around the process that could follow from there and any lingering doubts around the outcome of the election. So that in and of itself was a pretty positive thing. And then if you think about the incoming administration and their initiatives, the market has seen some of this before during their first term, of course, from 2016 to 2020. So you can see some assumptions being made around the impact that different initiatives had during that time period in the first term and how it's translating to what people are expecting sort of in immediate reactions with the administration moving forward from here. So that's the stock market. We also took a look at bond market returns. This chart is set up in a very similar fashion, 12 months before and after the event, color-coded again based on whether the incumbent won or lost. You can see here, relative to the stock market chart, that the variation in returns isn't that significant across any single time period. And that's not that surprising, as bond returns are pretty specific in terms of the price you paid for the bond, the coupon that the bond has, and how long you held it. So not that surprising. What we think is interesting, and especially over the last few decades, as federal government spending has increased, federal borrowing and the federal deficit and debt burden has increased, we think, if anything, you should start to see a more significant impact in the bond market over time. So we're a little surprised that there wasn't a little bit more statistical significance in this chart. Because if you think about it, the difference in federal spending initiatives are often funded by government borrowing. That borrowing is a function of U.S. Treasury bond issuance, which can definitely have an impact on the supply and demand of bond issuance across the bond market. So there were no clear significant results in terms of this analysis thinking about the bond market, but definitely we could see some volatility pick up, and we saw yields back up in the immediate response to the election in the last few weeks. So if we think about the outcome of the election, it was interesting to compare the two different agendas. This chart shows the different spending and revenue generating initiatives from both parties. So the Republican proposals on the left, the Democratic proposals on the right. And what's interesting is, although their priorities and agendas are very different, if you look at the bottom line net impact in either scenario, both campaigns, both parties would have increased the federal deficit by trillions of dollars over the next 10 years. So about $2 trillion of impact on the right side in terms of the Democratic plan, and a little over $3 trillion from the Republican plan. Now, if we look at the left side a little bit more closely, it has a lot of the elements of the incoming administration's initiatives outlined there. We think there are four big things that the campaign that the administration has outlined in the past, which were similar to what we saw during the first term. So what are those elements? It was tariffs and immigration control, tax cuts or tax reductions, and deregulation. So a lot of those elements show up in that chart on the left, whether it's referring to repealing clean energy subsidies or tariffs directly, or some new incremental ideas on tax cuts. And then most importantly, perhaps extending the expiring tax cut package. I think I read that if that tax cut package that was previously put in place were left to expire, roughly 75% of all taxpayers would see some form of an increase thereafter. So a pretty broad agenda and different initiatives. The net impact, a little over $3 trillion in an increase in the deficit over the next 10 years. Now, we've highlighted in prior conversations just how important we think this federal budget dynamic is. We think it's relatively unsustainable that we can continue this level of deficit spending indefinitely into the future. The level of aggregate borrowing is now equivalent to the size of the overall economy, so 100% net federal debt to GDP. And something will have to change. Something will have to give at some point in terms of those dynamics going forward. Until it does, we think there'll be more episodes in the market of sort of these crises, mini crises around debt ceiling debates or funding the government, which creates some disruptions and dislocations in the market and some volatility along the way. So this chart shows one thing that we think maybe could be a potential catalyst for change. The chart on the left-hand side shows, in the blue bars for the most part, the level of federal deficits over the last several years, going back through the 1980s. And then the black line on the top shows the trend in net interest costs on the debt over the same time period. And you can see the punchline in the chart there that the level of federal net interest costs has been rising quite rapidly in recent years. You can see that that's a function of the size of the increase in the annual deficits over the same time period. And then, of course, it's been a function of increases in interest rates over the past few years as well. What's interesting is to make the comparison in the pie chart on the right-hand side. In the light blue area, we see that net interest costs last year in the federal budget cycle were about $843 billion. And that compares to, if we just focus on one area, the light green area, $798 billion spent on national defense. Now, the U.S. spends more on national defense than any other country in the world. And in fact, it spends more on national defense than many countries combined. So it's quite amazing in some sense that we now spend more on interest on the debt than we do on national defense. And you can see the projection back on the slide on the left-hand side that the level of net interest costs is expected to continue to increase going forward. So it could be the case that as interest costs continue to rise, let's say they now reach over $1 trillion in coming years, maybe that'll force some discipline in making spending decisions. Maybe it'll crowd out some initiatives and be a potential catalyst for change, or at least that's what we hope for sometime in the near future. Now, that's a good way to segue to the topic of interest rates and just thinking about recent events there. Of course, we've seen a change in the Federal Reserve's policy around raising interest rates or tightening policy to now easing policy and lowering interest rates. That's been a significant change. What we want to focus here is a little bit about what to expect going forward, both what was our baseline sort of projections for next year, as well as how that's changed post the election. So this chart shows the time between the last hike in the tightening cycle and the first cut in the easing cycle from the Federal Reserve. As you can see, what it really highlights is that in most cycles from the Federal Reserve, it makes a pretty smooth transition of maybe a month or two between the last hike and the first cut. So a quick sort of changeover in terms of policy dynamics. What's interesting, of course, is that after interest rates were held at such low levels for, let's call it the last 15 years plus, and then the Federal Reserve started to move pretty quickly to increase interest rates over the last 2 years, and then it held them there for an extended period of time. This chart shows about 14 months between the last hike in the summer of 2023 and then the first cut in September, just a month or two ago. So why did the Federal Reserve raise rates so quickly and then hold them there for an unusually long period of time relative to what it had done in the past? Of course, I think we all know the answer. It has a lot to do with inflation, right? So coming out of the COVID pandemic, the Federal Reserve made an assumption that maybe the surge in inflation was going to prove to be transitory. As that proved to be a bad assumption, they moved pretty aggressively to raise interest rates to start to rein in inflation and slow down the economy. The good news in this chart is that they were successful with that. We can see that peak levels of annualized inflation declined from 8.5%, 9% in the summer of 2022 down to around 2.5%, 3% more recently. Now, in terms of the outlook for inflation going forward, we would have told you before the election results, we would have suggested that if anything, based on these trends and the different contributing categories of inflation that are color-coded on this chart, we would have expected that inflation would likely hold kind of around these levels, call it a slightly above average, 2.5%, 3%, maybe 3.5%, compared to the Federal Reserve's longer-term target of 2 to 2.5%. So our baseline assumption was that inflation and inflation expectations were probably going to be a little bit above average heading into next year. If anything, now that you think about the incoming administration's sort of playbook and the different initiatives that they're prioritizing, we'd now say that there's probably more upside risk to inflations in the outlook for next year. So tariffs and immigration control for sure restrict supply and demand in different markets. Other initiatives like tax cuts and deregulation can be pro-cyclical, pro-growth. That could help stimulate inflation in different ways as well. So the overall package of fiscal policy initiatives from the new administration probably, if anything, puts some upside risk to inflation over the next year or two. To be determined how policy is implemented, kind of in what scale and in what time frame. So it could be a little bit choppy in terms of how inflation readings could progress over the course of next year. So what does that mean then for the path of interest rates from here? This chart shows the trend in the Federal Reserve's Fed funds rate. This is their short-term target interest rate that they control to help set policy. It goes back through the 1990s. The dotted lines on the far right side of the chart shows two different sets of projections. The dotted blue line shows what the Federal Reserve itself has been projecting and forecasting and telegraphing to the market. And then the green line is market expectations. Now, this chart is post the election, so after the election results, and already includes some assumptions on how the market's been reacting. What I would tell you is before the election, the line for market expectations was right on top of where the Fed's estimates and projections were all by themselves. So that came right after the first cut in September. Market expectations and the Fed's projections were pretty much in sync. And that expectation in general was that the Fed was going to reduce interest rates, its short-term target interest rate from, call it 4.5%, 5% down to a level of closer to 3%. What you can see post the election is that the market is now priced out, maybe let's call it 75 to 100 basis points or 1 percentage point of rate cuts over the next year or two. So a shallower path of interest rate reductions, maybe a higher end destination in terms of where this cycle could be. That's all to be determined. The gap here in expectations really just highlights that there's some uncertainty and risk now as we think about the impact of potentially inflationary policies and how those will get implemented next year. The Federal Reserve for sure will take a sort of cautious approach to it, probably reduce interest rates one more time before the end of this year, and then maybe slow down a little bit to assess the impact on the economy of different initiatives from the new administration. So what does that mean for borrowers and savers? Well, if we think about saving and investing at these higher levels of interest rates, that's potentially a good thing compared to the levels of yields we were able to get on cash reserves or short-term investments over the past 10 to 15 years. So that's a really good thing to get a little bit higher level of yield for a little bit longer than expected. Of course, the flip side of it is for borrowers, higher short-term financing costs will kind of weigh on their ability to help support their businesses. So some pros and cons there for sure. Now, one more point about interest rates. A key question we usually get from clients when we start talking about the Federal Reserve reducing interest rates and easing policy is, well, isn't that good for the stock market? And the answer is, well, it sort of depends. This chart gives us some history for the context around that. It shows in the black line, again, the Fed funds rate, the short-term target interest rate, now going back further through the 1970s. And then it overlays in the yellow line, the trend in the S&P 500 index or the broad stock market. And then in the shaded gray areas are prior recessions in each of the previous cycles. And then what's circled is what happened right around the time of the first interest rate cut in each of the prior easing cycles. And you can see here that 4 out of 6 times in those prior cycles, that first interest rate cut often led to or was coincident with the start of a recession, and it led to subsequently the stock market went down before it started to go up again. So that hasn't always been the case. In this environment today, we think the risks to the economy have been elevated for the last year or two. If we think about that in the context of where inflation was, how aggressive interest rates have moved higher. But we've been surprised at how well the economy has been supported and how well it's held up despite all these challenges. Some sectors are definitely struggling. The manufacturing sector, the housing sector remains stressed. But the government sector has been supporting spending. The consumer sector has been holding up pretty well, relatively speaking. So we're remain constructive on the outlook for the economy, but of course, everyone's going to take a little bit more cautious approach as we see some new initiatives put in place next year. So what would it take then for the stock market to continue to move higher? This is another key question in the conversation around all these different dynamics around fiscal policy and monetary policy. We think the best place to start there to really give some context is just what's been driving the market more recently. And then what would it take in terms of the market dynamics to help continued appreciation moving forward? So to give some context around what's been really driving the market over the last few years, this chart helps break down the impact of the so-called Magnificent Seven, these 7 large cap tech companies that have really been key drivers in terms of overall market performance and have really outpaced the broader market themselves. So the Magnificent Seven stocks, those large cap tech companies, are shown in the green. The other 493 companies in the S&P 500 are shown in blue, and then the S&P 500 average overall is shown in the black. So you can see the different trends in the dynamics and how that's progressed over the last few years. The table at the top of the chart, we would just highlight, if you look at the share of returns generated by just those 7 companies over the past 2 years, it's been pretty significant. Upwards of 50 to 60% of overall market returns have come from just these 7 companies. Now, what's interesting is if you look at the S&P 500, excluding those companies, and you look at year-to-date performance, this was through the end of September, so for the first 9 months, the rest of the market was up around 11%. That's pretty good relative to long-term historical averages. But of course, if you didn't have exposure to these 7 companies that have been driving returns, you missed out on another 10 percentage points of returns. And this has been the case in some of our high-quality equity portfolios that have been relatively concentrated. We own some of these companies, but not necessarily all of them. So that creates some return variance in terms of performance throughout the course of this year. Now, what has to happen here in terms of stock market leadership going forward? Well, it's interesting to take the same look based on corporate earnings growth. This breaks down earnings growth for just those 7 companies, the Magnificent Seven, versus the rest of the market. And you can see in the green for the Magnificent Seven, over the last 2 years, 2023 and then this year, their earnings growth has been quite strong, on average above 30%. So definitely some of their appreciation and performance has been warranted by their very strong and above average earnings growth. The challenging aspect of thinking about where does the market go from here is in the blue. The rest of the market, if you kind of average it out, has really seen sort of flattish earnings growth over the last 2 years. So that dynamic really needs to change. Now, there are some potential catalysts for that if we think about the incoming administration and what worked well in their first term. It could be the case that other parts of the market start to perform better, start to see some positive dynamics in terms of earnings growth, and this dynamic could shift and help some sector rotation and driving market leadership from here. The challenge is that no matter how you slice it, this is looking at the top 10 stocks versus the rest of the market and then the broad market averages. No matter how you slice it, the market is trading at above, the stock market is trading at above average price to earnings ratios. So this chart shows the trend in the forward price to earnings ratios for the different parts of the market. If you look at the table on the top, you can see again, whether we're looking at the top 10 or the other 490 companies in the S&P 500 or the broad average itself, by any measure, stocks are trading at above average valuations relative to their historical trends. So that's the challenge. Even if we can see better earnings growth from here, it comes against the backdrop of already high valuations. So what do we expect going forward? Well, we really hope for and expect that there will be some change in stock market leadership. Some of the immediate responses we saw post-election in different sectors are very encouraging that could help drive some different dynamics and a broadening out effect, if you will, in terms of overall stock market performance. Hopefully, we're not saying that the Magnificent Seven companies won't continue to do well. Those are based on their fundamental outlooks for sure. But what we do hope to see is that other sectors, other parts of the market will start to have stronger earnings growth, and that'll help support their performance going forward. This chart looks at the weight of the top 10 holdings in the S&P 500, shows you the trend going back to the late 80s, early 90s. You can see the tech bubble peak in late 1990s, early 2000s, around 25% of the market in the top 10 holdings then. Today, you can see the level of concentration is even higher, up to 35% in the top 10 holdings. So that's an unusual level of concentration. It's created a very large variance in terms of market performance, whether you owned these top 10 or 7 companies or you didn't. And then what we think could be a good sort of precedent for what we've seen before, if you look at what happened after the tech bubble peak, again, sort of a gradual decline in the level of concentration as other parts of the market started to perform and the dynamics started to change. So we hope that's the case going forward. Obviously, difficult to predict timing of when it could occur, but that's what we would look for to continue to be constructive about the stock market and hope for continued appreciation over the next year or two. So I'll wrap up some of our key takeaways and then we can open it back up for questions. But some of the key conclusions, again, if you think about the new fiscal policy package, if you think about the incoming administration and their playbook, definitely presents some risks, as Dimitri mentioned earlier. A lot of this will to be determined in terms of how it gets implemented and different policies and different initiatives impact the economy, companies, earnings growth, and the stock market overall. That could have an impact on the path of interest rates going forward as well. So our bottom line message on all this is, of course, with these risks in mind and with above average valuations for the stock market, we would continue to remain cautious in thinking about our overall asset allocations and particularly how much exposure you have to risk assets. Not a great time to take incremental risk necessarily. Of course, when valuations are cheaper, prices are lower, that's a much better time to take risk. We remain constructive on the outlook, but again, there'll be a lot that we'll have to keep an eye on next year as new policies are implemented. Another consideration, before we wrap it up, is thinking about inflation. So if it is correct and there is some upside risk to inflation, that would be a good conversation to have with your advisor about other ways in your asset allocation to help protect your purchasing power and sort of meet your goals and objectives, especially if you have some shorter term spending needs. So definitely something to think about as you think about your overall asset allocation and your work with your advisor on your plan for next year. So I'll stop there and we can open it back up for questions.
Thank you, Chris. Great job there. And we did have a number of questions come in through the Q&A in the chat and even prior to this presentation. So I'll kick it off where you just finished regarding inflation. One of the questions was specifically what types of investments or asset classes should we consider to protect against inflation in our portfolios long term?
Yep, great question. So we see a lot of inflation protection just come by owning stocks somewhat naturally. Really high quality companies with strong pricing power can, of course, pass along pricing and help protect against inflation. There are other forms of equities that also have good inflation sensitive characteristics. Those could be energy related equities or commodity related equities, real estate related investments as well, and then even commodities directly themselves can provide different inflation protection characteristics in different environments. So there's lots of different ways to think about it, but the main message is everyone gets some natural inflation protection by their natural stock exposure. And then there could be additional ways to help complement or incrementally add to that protection as well.
Thank you. Along those same lines, what is the firm or your opinion and thoughts on an appropriate allocation, if any at all, to commodities, precious metals, gold, other rare earth funds? Is the guidance, a 5 to 10% allocation or something different, if anything?
Yeah, absolutely. So Dimitri stole the punchline there, but generally speaking, depending on your goals and objectives, depending on your longer term financial plan and how your asset allocation is designed, it could make sense to include anywhere from 5 to 10% of your overall allocation in things like commodities or metals or these other inflation sensitive assets like real estate and so on. It could be a good idea to help build in some purchasing power protection.
Thank you. So we'll pivot a little bit, and we'll go back towards the equity markets. Question came in. There's a lot of noise right now about policy changes, in particular around tariffs. Will there be an impact on our international stock exposure? Is that something to be concerned about or not?
Yeah, it's a good question. Some very interesting dynamics there. It depends on how tariffs are implemented, right? There's been some conversation around a 10% across the board tariffs. That's difficult to implement without congressional approval. What could be implemented more quickly are different case by case, sort of market by market tariffs, depending on different product dynamics, where importers and exporters are located. So there could be sort of case by case impacts on different industries more broadly that could not only impact US companies as well, but international companies, depending on where those goods are manufactured and so on. You saw the move in the dollar. The dollar reacted pretty quickly to strengthen on some of these ideas. The strengthening dollar, puts a little bit more price pressure on U.S. exporters, for example. So some of these dynamics get offset in the currency markets as well, where it could lead to international companies, depending on where they're located in terms of their production, could have some advantages going forward. So the general answer is, of course, it depends. It depends on the market and the different dynamics, sort of company by company.
Thank you, Chris. So I'm combining here, summarizing here a few questions that all fell under the same theme. Warren Buffett has been selling stocks and raising cash. Should we be doing the same? Is now a good time for profit taking and rebalancing in one's portfolio?
Yeah, it's a great question. It's definitely in line with our thinking. Given how strong the market has been over the last 2 years, obviously there was a pretty healthy correction in 2022, but the performance last year and this year, and again, since it's been so concentrated in the stock market around a few companies, we would definitely encourage everyone to take a look at their asset allocations relative to their longer term targets. And if you haven't rebalanced already, now is probably a good time to at least rebalance back to your longer term policy targets.
Thank you. This other question that came in, I'll answer. I'll give you a little bit of a break, Chris. So there was a question about the idea of being floated around under the new administration that there could be no tax on Social Security income and what impact that would have on planning items like Roth conversions. So I'll try to answer that. It's really hard to speculate on tax policy and tax policy changes because it really comes down to specifically the words of any new tax policy that gets passed in this country. Theoretically, if Social Security was not taxed and one was in a position in their lives or their financial lives where a Roth conversion could make some sense or is something to consider. The way a Roth conversion works is you have money in a traditional IRA or 401k plan, and you decide to convert to a Roth. That transaction, that conversion is taxable. And it's not just that amount that's taxed, but it's your overall income that's taxed in any given year. So if somebody is receiving, in an example, $30,000 or $40,000 a year of Social Security that is taxed, and there's some new policy in the future that doesn't tax that amount, it could give more opportunity for things like Roth conversion. We don't know. We don't know if that's going to happen. We don't know if that income would be included or excluded. But it is something that we as financial planners and advisors look at. But we've also learned over the years that there's always speculation about changes to the tax code, and we should really be taking action when we have a lot more certainty. But that was a really good question. Next question back to you, Chris. What is the firm's position on cryptocurrency, specifically Bitcoin?
Yeah, great question, especially in response to the rally that Bitcoin's had post-election. So we are, in general, very constructive on Bitcoin and the longer-term potential of cryptocurrencies as a mechanism. In some sense, Bitcoin, you can think of it in the simplest form as like digital gold. It has some characteristics similar to the way some people think about investing in gold, but of course, it's not physical. But what we've suggested that people consider is if you are interested in potentially having some exposure, there are some complicated ways to do it. So definitely take some consideration to how you want to own it through vehicles, through funds, through outright. There are definitely some important considerations there. And then when you think about sizing it, it is still in its early stages of development. Some regulatory support, of course, would be supportive for its longer-term development, but that's still to be determined. So we would continue to recommend a very small allocation. For clients that have asked us about it and have been interested in pursuing an investment, our suggested recommendation is around a 1% allocation. That may not sound like a lot, but looking at the historical volatility for Bitcoin, and given that it's pretty speculative and still in its early stages, it seems reasonable, again, if you want to have some exposure, to minimize your risk in terms of thinking about your overall allocations.
Great. Thank you. Another question that came in, I'll frame the question, Chris. I'll answer it first, and then you can chime in if you'd like. But the question is there a concern that next year's Congress may look to tax retirement funds as a way to pay for other tax cuts in a, possible tax package? And the way I would start answering that question is, I think that's not specifically about taxing retirement funds, but Chris showed a slide earlier in his presentation that showed how, the policies that have been presented to us, which again are more theoretical and not in force, do impact the deficit in this country. And so the question is, how will some of these things get paid for, if there are tax cuts and other expenditures elsewhere? And it really, to me, comes down to all these different puzzle pieces that fit into the puzzle. It includes potentially tax cuts, it includes tariffs, it includes other pro-growth initiatives. We just don't know for sure, where that will be. I haven't personally seen anything about retirement funds being taxed. I think retirement funds continue to be a very powerful way for most American families to save for later on in their lives post working. Making a big change there, I think, would impact a lot of people.
Yeah, it's great, Dimitri. I don't have anything else to add.
Okay, and then the final question that we received said, based on a recent client survey that I completed, I got the feeling that the firm, Curi RMB Capital, is planning on expanding in a way that may take away the personal touch we receive now. Should that be of a concern to us? It is a great question. It is a question that comes up often. It's come up before our two organizations merged, and it's come up since our two organizations merged. And I was in a meeting earlier today with one of our teams and our clients, and that client asked the exact same thing. There's a number of different answers to this question that all tie together. First and foremost, this organization, separately and now combined, has grown to serving 3,100 families around the country, primarily through the really good work that our teams do and through the relationships that we've built. No matter what our growth looks like going forward, we do not want to lose that. And over the years, the growth and the changes that you have all seen that have been clients of ours for a while have truly come from the changing needs and goals of our clients. Our clients grow. Our clients' financial lives have grown. Our clients are moving to different parts of the country. Our reasons for hiring more advisor teams and analysts is partly to continue to meet our clients where they are. We've opened up offices around the country in areas where we continue to have a growing client base, because for many people, being local matters. So what we're working on is continuing to be a national firm with institutional quality resources, but to continue to provide that local personal relationship that you're all very used to. Why we want to continue to grow, there's a number of different reasons. First and foremost, it's people. People want to be part of an organization that's progressing and growing. We want to attract the very best people. We want to give them the opportunities to build their careers here, and we want to retain them. And doing so in a growing environment makes that easier. We want to provide more services and solutions to our clients. Some of the latest investments that we've made there, many of our clients over the years have asked us to work with their children or their grandchildren, who are just coming into financial well-being and wealth and having financial planning questions. So we launched a team over a year ago called Wealth Builder to help those families at that stage in their lives. We've had clients who have built businesses and have created some complex questions and financial situations that they've wanted us to help them work through. And we have a team that's dedicated to that. We have individuals on our team that are certified public accountants and estate planning attorneys by trade. Now, we don't draft wills and trusts for our clients, but we can bring really deep expertise and guidance from an estate planning perspective that clients can then take to their estate planning attorneys when there is a need for an update. We do have the desire to find really good people and partners through M&A, but our M&A will be very thoughtful and it will be very strategic. As I said at the beginning of our presentation today, we have competitor firms in our space that are doing M&A monthly, and doing dozens of transactions a year. We do not anticipate being the pace of our growth. We think our pace will be something like 12 to 18 months, but really, when we find the right people, we find the right team. We have other geographies that we want to have a local presence in because we have clients in those geographies. So as we grow, we're going to grow in a really thoughtful way, and we're going to grow so we can continue to maintain and expand on the services and the solutions that our clients are used to. And as the world changes, we want to change with it and make sure we're the right organization for you for the next 5, 10, or 20 years, just like we've been for the prior 20 years. So thank you for all of these questions and this engagement. We will continue to have webinars and events like this. And if you have any specific topics that you'd like us to address in a future webinar, please share that with us. And we look forward to seeing you again later next year. Have a great Thanksgiving and a happy holiday season. Thank you.